Hi everyone, welcome to our next topic. This week we're going to be looking at topic 11, which deals with international financial management, which is, I think it's really important topic because it really does affect just about everyone, whether you're working, whether you're traveling, whether you're going on a trip, any of those kind of things. Okay, so let me just share the screen and we can get started. All right, so in this scenario, we can talk about the fact that globalization. So globalization refers to the removal of barriers to free trade and a closer integration of national economies. What this means is that consumers in many countries buy goods that are purchased from a number of countries, not just their own. So we buy our electronics that may have been produced in China, our clothing may have been produced in Sri Lanka, our electronics may have been designed in the US. And at the same time, those companies need coal and those sort of things which they've purchased from Australia. So the production of goods and services has become highly globalized. And like product markets, the financial system has also become highly integrated. And the reason for that is really because of technology. It's so much easier to do business internationally. So a multinational company is a business that operates in more than one country, but is headquarters or based in its home countries. Multinationals are owned by a mix of domestic and foreign shareholders. Okay. And, you know, there's just so many that we can talk about here. So here's an example of some of the larger multinationals. It's not a great example. It's from 2016, but you can see that we've got Royal Dutch Shell, which is a fuel company. And we can see that it had revenue of 240 billion US dollars. That's how big these companies are. But having said that, multinationals could also be quite small as well. It depends. If we go back to the definition, okay, it operates in more than one country, but it's headquartered in a home country. So they can be small as well, okay? So there's 6 factors that can cause international business transactions to differ from domestic deals. And I could probably summarize them in 2, which are the most important, being exchange rates and political risk, okay? So the uncertainty of foreign exchange rate movements is called foreign exchange rate risk or just exchange rate risk. Differences in legal systems and tax codes can also impact, and that's usually going to be political risk. Governments can change their mind, okay? While English is the official business language, we talk a lot of different languages around the world, and so that would have an impact on us doing business. Cultural views also shape business practices, what people find important, what they don't find important, okay? An economic system determines how a country mobilizes resources to produce goods and services, as well as how production is distributed. So are we a developed economy, developing? That can have an impact on the way business is operated in terms of the types of businesses and the size of businesses. Country risk refers to political uncertainty. Well, that goes really back to point 2, is also about political risk as well. At the extreme, a country's government may even expropriate a business's assets. These type of actions would impact on cash flows, okay? So when we looked at week 1, we talked about the goal of financial management, okay? Now, it's really interesting here. Stockholder value maximization is the accepted goal for companies in the US, as well as in other countries like Australia, the UK, Canada, whatnot. And that's because a lot of these countries have their legal system based on common law, okay? In continental Europe, okay, countries such as France and Germany focus on corporate wealth, okay? So what that means is the European manager's goal is to earn as much wealth as possible for the company while also considering the welfare of its stakeholders. So in Australia, our laws talk about protecting shareholders. In Germany, etc., their laws talk about protecting stakeholders. In Japan, companies form tightly knit interlocking business groups called a keiretsu, and the goal of the Japanese business manager is to increase the wealth and growth of the keiretsu, okay? So they might focus on things like market share for the group, okay? Now, foreign exchange market is a group of international markets connected electronically where currencies are bought and sold in wholesale amounts, so probably $1 million minimum. Now, what do? They provide a mechanism to transfer purchasing power from individuals from one currency to people who deal in a different currency, i.e. we can basically exchange money so that you can transfer your purchasing power from being in US dollars to euros, okay? A way for companies to post, so that's just exchange, right? Number one. Number two is a way for companies to pass the risk associated with foreign exchange price fluctuations to professional risk takers. So what that means is we can manage our risk, okay? A channel for importers and exporters to acquire credit, so you can borrow money in this market. Now, participants are linked by telephone, telegraph, cable. The major participants in the foreign exchange markets are multinational, commercial banks, large investment banks. A currency boutique is just a small currency trader. In addition, the central banks, such as the Reserve Bank, are also going to be involved in this market, okay? Now, as you know, a foreign exchange rate is the price of one monetary unit, okay? One of the two parties in a foreign transaction will be forced to deal in a foreign currency and therefore incur foreign exchange risk. So if I'm an importer, I might have to pay in US dollars for an American exporter. Because I'm an importer and I'm paying in US dollars, I'm going to bear the foreign exchange risk because the currency could move with me or against me, okay? With this in mind, we often talk about the equilibrium exchange rate. And put simply, that's the price or the point at which the supply of currency is equal to the demand for currency, okay? And so therefore we have our equilibrium point, which will be the exchange rate at the moment, okay? Now, equilibrium occurs at the price at which the quantity of the currency demanded exactly equals the quantity supplied. In general, whatever causes, say, US residents to buy more or fewer goods shifts the demand curve for foreign currency. So if people in the US and suddenly they're buying a lot of goods on Amazon from Australia, that would shift the demand curve because they would demand Australian dollars, but it would also shift the supply curve because they would have to sell US dollars to fund that. Now, fundamentally, there's a lot of theories about exchange rates, and we're going to talk about them. But one of the most important things to keep in mind, I think, is that supply and demand plays a really important part when it comes to currency, okay? The spot rate is the cost of buying a foreign currency today on the spot, okay? If the exchange rate is the price in dollars for a foreign currency, it is often called the American or direct quote. If the exchange rate is the price in foreign currency for a dollar, the quote is often called a European or an indirect quote. Now, I don't want you getting too worried about that, okay? European, direct, indirect, don't get too worried about that. It's not that important. And principally, I wouldn't really ask you a question about that in the exam. I think that's, I don't think that really addresses the big issues that we're dealing with in our course, okay? But what is important is you know what a spot rate is. So that's the rate today, okay? When you talk about direct, indirect, American, European, again, like options, nothing to do with America or Europe, okay, fundamentally. So here's some examples of some rates that you can have a look at and the way that they're quoted in different methods versus different currencies, okay? Now, what is important is foreign exchange dealers. Now, we have brokers and we have dealers. A broker matches buy and sell orders and charges a commission. A dealer, they quote two prices. The price at which they're prepared to buy shares for and the price at which they're prepared to sell, not shares, sorry, foreign exchange. So the price at which they're prepared to buy foreign exchange for and the price at which they're prepared to sell foreign exchange for, okay? They will hold an inventory of currency because they're buying it and they're selling it. Just like if I was a motor dealer, I would have an inventory of cars. So the bid price is what they're prepared to buy for, and the ask is the rate that they're willing to sell for, okay? When one is given two quotes of foreign exchange rates involving three currencies, it's possible to find the exchange rate between the third pair of currencies, and this is known as the cross rate. We'll come back to that, okay? The forward rate is the rate that one agrees to buy or sell a currency at some future date. So we enter into a contract today with an agreement to buy or sell currency in the future. Unlike an option, you're locked in, okay? Now the forward rate, the rate that you agree, is established at the date on which the agreement is made and defines the exchange rate to be used when you finally settle the contract, maybe 3, 6, 9 months into the future. So by contracting now to buy or sell foreign currencies at some future date, businesses can lock in the cost of foreign exchange at the beginning of the transaction, and then they don't have to worry about unfavorable movements. Yes, if they had have waited and not entered into a forward contract, the exchange may have been unfavorable. Alternatively, if they hadn't have entered into, it may have been favorable. But at the end of the day, what we're trying to do here is we are trying to minimize uncertainty. So by locking in a rate, we know exactly what is happening. The difference between the forward and the spot rate is called the forward premium or discount. If the exchange rate is expected to strengthen, we say it has a forward premium. If it's expected to weaken, it has a discount. Now this slide looks at the world's largest banks, okay? And as one would expect, there's some very similar or names that you would know, okay? If you went to the top 30, you would see a lot of Canadian and Australian banks in that list, okay? Now, what are the risks involved in international banking? Well, the principles of loan administration and credit analysis, i.e., is this a good loan or not? Should I lend this money? Are very similar, okay? However, there are some additional risk exposures, okay? Credit risk is the same as to whether the loan is domestic or international. However, it may be more difficult to obtain or assess credit information abroad. So you may have less information, or it could be irregular or incorrect, okay? Bank loans that have foreign exchange risk will carry an additional risk premium. You might be a British bank, but you're being paid in euros. Therefore, there's more risk. You're going to charge a higher interest rate. Okay. If an international loan or investment is expected to suffer some form of loss because you may not be repaid, there's going to be an additional risk premium. Now, I've just included this here. It's just interesting. Okay, don't get too stressed about it. It's not examinable, but I just wanted you to show a few ways when you work in foreign exchange and when you work in markets, people use a lot of words that may not make sense. Okay. Now, foreign exchange dealers quote two prices, as we said, bid and ask quotes. The bid quote represents the rate at which the dealer will buy foreign currency. The ask quote is the rate at which the dealer will sell foreign currency. And the bid-ask spread is, I always remember it as ABA, ask minus bid over ask, okay? There's a lot of theory associated with the bid-ask spread, and you'll see the formula used different ways. It really depends on how the exchange rate is actually quoted, okay? So we just got to keep that in mind. Now, the economic theory. So a lot of what we talk about in finance has its basis or birth in economics. In fact, finance is a subset of economics if you think about it. The economic theories that link exchange rate, prices, and interest rates are called parity conditions. Now, these form the core of a finance theory that's going to be unique to international finance, okay? So the first of these is the law of one price. And this says if the identical product or service can be sold in two different markets and no restrictions exist on the sale, and transport costs of moving between the costs between markets are equal, then the product's price should be the same in both markets, okay? What this means is that a primary principle of competitive markets is that prices will equalize across markets if frictions do not exist, okay? So for example, if one good was more expensive in one market and cheaper than another, people would buy it in the cheaper market, sell it in the more expensive market to make a profit. Eventually, this profit would disappear as the market becomes aware. Comparing prices then, if the prices around the world were all the same, would only require a conversion from one country to another, okay? So we would say it's the same price around the world, okay? So if the law of one price were true for all goods and services, by comparing the price of identical products denominated in different countries, we can work out what we call the real or purchasing power parity exchange rate, okay? And this is called the absolute version of purchasing power parity, i.e. prices should be the same all around the world. But that's not really flexible because I can't buy haircuts in New Zealand and sell haircuts in Sydney. PPP really only works for homogeneous goods like gold, minerals, those types of things, oil. It doesn't really work for a lot of things, okay? Now, another version of purchasing power parity is what we call relative purchasing power parity, and it's relaxed a lot of the assumptions of the absolute version, okay? And according to relative purchasing power parity, inflations between two countries over a period of time determines the change in the exchange rate, okay, over that period. So what we basically say, under relative purchasing power parity, we can look at the differences in inflation between two countries, and it's going to give us an indication as to whether exchange rates are going to strengthen or exchange rates are going to weaken. So if you have two countries and one country has a higher inflation rate, we would expect the value of their currency to weaken. Alternatively, the country with the lower inflation rate, I'm not sure I said inflation rate last time, but the country with the lower inflation rate, their currency will increase or strengthen. So there's an inverse relationship there. Now, empirical tests of purchasing power parity theory have not proved PPP to be accurate in predicting exchange rates. PPP holds up well over the long run, but poorly for short run. So it kind of makes sense in the long run, they're saying. It also says the theory holds better for countries with relatively high rates of inflation and underdeveloped capital markets. So if you're looking at that, we'd probably say the most use of PPP is a long run measure, not to predict an exchange rate, but to tell us as to whether a country's exchange will strengthen or weaken, okay? So the determinants of the Australian exchange rate is going to be whether it has a higher or lower inflation rate than its trading partners. That's based on PPP. So as I said, where a country has a higher inflation rate than another, the country with the higher inflation rate will see a depreciation. The terms of trade is another measure. The strong increase in commodity prices that began in 2002 in Australia boosted the terms of trade, okay? Don't worry about that second point. The effect of capital transaction. Impact of factors such as the relative rates of return on Australian dollars and changes in investor confidence. Are people looking to invest in Australia because they can get a higher return, okay? For example, we saw a lot of money pouring into the resource sector. We've got good political stability. We've got sound economic management. I think we've had positive GDP growth every year since about 1991, okay, which is just unheard of really in the big scheme of things. So those sort of factors will determine the demand for Australian dollars, okay? So that's important to consider. Now, another really interesting concept is the relationship between interest rates and exchange rates, okay? So, International Fisher effect. It talks about the relationship between the percentage change in the spot exchange rate over time and the difference between comparable interest rates in different capital markets. It says the spot rate should change in an equal amount, but in opposite direction to the differences in interest rates between the two countries. So let me put that in really simple terms. Similar to PPP, if you've got two countries and one has a higher interest rate, we expect their currency to depreciate. The country with the lower interest rate, we would expect their currency to appreciate. So basically what's happening, currencies are changing to remove arbitrage conditions, okay? Now, earlier we talked about entering into a forward agreement. Now, a forward rate is an exchange rate quoted for settlement at some future time. And like I said, a forward exchange rate agreement between currencies states the rate of exchange at which a foreign currency will be bought forward or sold forward at a specific date in the future. So the forward rate is calculated for any specific maturity by adjusting the current spot exchange rate by the ratio of interest rates, okay? So let me show you how this works here in this next slide. So let's have a look here, guys. We want to work out the forward rate. So we've got a situation, we want to enter into an agreement to buy or sell some currency at some time in the future. So how do we work out how do we work out, what rate do I use for when we exchange in 90 days time? Well, if we look at this formula, we say the forward rate, now that's Swiss francs per Australian dollar, is equal to the spot rate, Swiss francs to the Australian dollar. So what I like to say, it's Swiss francs over Aussie, Swiss francs over Aussie, Swiss francs over Aussie. And this is just taking the interest rates times the number of days. And yes, we do use 360. Okay, it's the way these rates are quoted. And we'd give you that advice in any exam question as to how to deal with that. And what I mean by advice, we'd kind of tell, or if it was a closed book exam, we'd remind you to use 360. If it's open book, obviously you know about that. The forward premium or discount is the difference between the spot and the forward exchange rate stated in annual percentage terms. It's an interesting concept here. Part of this really depends on again, the way things are quoted, but we'll come to that. Now, when we talk about Fisher, we talk about interest rate parity. And this is the linkage between exchange markets and money markets, i.e. interest rates. Okay. It says the differences in national interest rates for securities of similar risk and maturity should be equal to, but opposite in sign, to the forward rate discount or premium. That would imply there's no arbitrage opportunities. So in order for the two alternatives to be equal, any difference in exchange rates must be offset by the difference between the spot and the forward rate. This formula here, F on S, times 1 plus I over 1 plus I, that's just a rearrangement of this formula, okay? That's just a rearrangement of this formula. So this brings us to a concept called arbitrage. But first of all, let's have a look at how interest rate parity works, okay? Just say I had $1 million and my spot rate for Swiss francs was $1.48. And the forward rate, based on my interest rate parity formula that I just used here or here, okay, was equal to 1.4655. You can work that out, okay? You can work that out. Now, what we mean by interest rate parity is that there's no advantage in exchanging currencies. So if I was to invest, if I had $1 million Australian dollars and I swapped it at the spot rate for Swiss francs, that would give me 1,480,000 Swiss francs. Now, if the Swiss interest rate was 4% per year or 1% for 90 days, if I invested that at 1%, I'd end up with 1,494,800 after 90 days, okay? Alternatively, I could keep my $1 million in Australia, invested at 2%, i.e. 8% per annum, but 2% for a quarter. At the end of 90 days, I'd have 1,020,000. Now my Swiss francs, 1,494,800, if I swap that back at the forward rate that I've calculated, I should get 1019993. There's a little bit of rounding here, okay? But ultimately you can see I'm no better off whether I invest in Australia or I invest in Switzerland. That's what we call interest rate parity, okay? There's no arbitrage or riskless profit opportunity, okay? But this brings us to a concept called covered interest arbitrage. And this is the situation where the spot and forward exchange markets are not in equilibrium, okay? And this gives rise to the potential for a riskless or arbitrage profit, okay? The arbitrager will exploit the imbalance by investing in whichever currency offers the higher return. Now I see this term covered basis. It means that they've locked in a forward rate, okay? It means they've locked in a forward rate. So let's have a look at this one, okay? He has $1 million and he's looking at 180 days, okay? The spot rate is 106 yen to the dollar. So it's 8% to invest in Australia, or 4% to invest in Japan. Now, if he invests in Australia, at the end of 180 days, he's going to have $1,040,000. Oops. He's going to have $1,040,000. Alternatively, he could take his $1 million, convert it to yen, okay, and he'd have 106 million yen invested at the Japanese bank, and at the end of the day, he'd have 108,120,000 yen, okay, 108 million. Now, if he converts it back at this spot forward rate of 103 that he's locked in, he's going to end up with 1,044,000. Now, why is he making a profit? Well, based on what we know, okay, the forward rate is not what it should be. So if you took your calculator and I said, on my calculator, if I said the spot rate was 106 yen to the dollar times 1.02 divided by 1.04 using my interest rate parity formula, I should have a spot rate of 103.96. Sorry, I should have a forward rate of 103.96. I have a forward rate of 103.5. Therefore, it's given rise to an arbitrage opportunity for me. Covered interest arbitrage, like I said, if the difference in interest rates is greater than the forward premium, we invest in the higher yielding currency. If the difference in interest rates is less than the forward premium, we invest in the lower yielding currency, okay? Covered interest arbitrage opportunities continue until interest rate parity is re-established, okay? There is a version which is called uncovered interest arbitrage. So investors borrow in countries and currencies exhibiting low interest rates and convert the proceeds into currencies that offer much higher interest rates. The transaction is uncovered because the investors remain uncovered and accept the currency risk of exchanging the higher yield currency into the lower yield. So they don't lock in that forward rate, okay? They don't lock in that forward rate. So let's have a look here. I might have a situation where I can borrow yen at 0.4% of $1. So I might borrow 10 million yen. The spot rate is 120, so I'm going to convert it to 83,000 Australian dollars. But in Australia, I might be able to invest it in government bonds at 5%, so that at the end of 1 year, I now have 87,500 yen, $500. Now the spot rate may not have moved from the start of the year to the end of the year, okay? So if the spot rate hasn't moved, I then convert it back to yen, okay? So what's happening here? My $87,500 is worth 10,500,000 yen. I have to repay the bank and I end up with a profit of 460,000 yen. Now these trades were very common, and the reason that these trades were very common is that Japanese yen to borrow money was very, very cheap because of their recession that they were going through. And Australia, we had a really good economy a number of years ago, mainly before the global financial crisis, and government bonds were paying maybe about 5%. So there was a great opportunity to invest in government bonds, okay? And because they were government bonds, they were risk-free. So that was a really common, what we call a carry trade. Borrow in Japan, invest in Australia. It was almost risk-free except for the exchange rate risk. All right, I'm going to leave that video there. We do have some questions which start on slide 47, but I'm going to actually create a separate video so they're not too large for us to upload, okay? So I'll say goodbye now, okay? But we'll come back and we'll do the second video, okay? And you'll see it on iLearn. Thanks, guys.